Good evening and welcome to the FITT Show. Financial information for today and tomorrow. I'm Bobby Kinzer,
And I'm Thomas Doty.
and we are the FITT Show, helping our people get their finances in shape. We're here every week, Thursday at 8 p.m. Eastern Standard Time. We're not yet. Time's getting ready to go back, dope. How are you doing today?
Man, I'm down here in sunny South Carolina, doing all right.
That's a good thing. And I'm here in bright and sunny Bowie, Maryland. And we're coming to you today with some more information that we hope that you will share with your family, friends, co-workers. And remember, please click on the like button and the heart button so that we can get more traction and it gives us more access to more viewers. And make sure you share on Facebook Live and also subscribe on YouTube. We out there on YouTube too, and you can share YouTube also. So make sure you do that. Now we have this comment box down here. We might want to make sure that you put some comments in that comment box because that gives us even more access to people. But we want to hear some of the things you want to talk about, or some of the opinions, or you might have some good information that we can share with other people too. So please make sure you put stuff in that comment box, and we're looking for more and more topics as we go on. This is our 73rd show, dope.
Wow.
73. And just want to remind people that me and Thomas Doty are not qualified financial advisors. We're not certified. We do not have any fiduciary responsibility. We are what they call financial educators. So information that we're giving you is not for your specific personal portfolio. You should go to a qualified financial advisor to get advice if you want personal information. But the information we give you, it is information that you can use because a lot of people, and we're getting a lot of calls from people about different things. Dope. A gentleman walked up with me on the street who says he watched the show that I know. He said, Bob, man, I got this fidelity count. It's losing like a mug. Oh my God, what should I do? I said, look, man, I can't tell you personally what to do, but in generally, everybody's money is down. So that's a good segue to bring us into our top topic, the top of all topics. We start off with a stock market update.
It's been a pretty quiet week this week. It's if you look at the Dow, it's up about 300 points or 1%. Nasdaq's down slightly, only 35 points, and stocks have been pretty quiet. Microsoft's up 2. Tesla's down 15. They missed their delivery target, and they announced their earnings, and they were a little bit below expectations, and so their stock took a hit there. But I think overall things are looking up. Things are looking up for Tesla, and Apple and Pfizer both stayed pretty flat. And it's just been a lot of news about inflation in the market, and of course that's still what's dragging the stock market down, is that as interest rates rise, which is kind of the Fed's plan, the 10-year Treasury yield hit 4.23 on Thursday, which it hasn't been that high since 2008. And so the rising rates are basically keeping stocks from going up because people have alternative place to put their money. So as the Fed continues to raise interest rates, it's probably going to cool off the market for a while. And so you can expect things to continue like they are. Now, the positive you have is that several companies have had some pretty strong earnings, and that's kind of keeping things from getting even crazier than they would have. So you got the inflationary pressures and the rising rates, and bonds are recovering and things of that sort, kind of pushing stocks down, but earnings are still coming in, pretty good. And several of the big companies announced earnings, and they were all good. Of course, Tesla didn't, but most others are coming in positively. So that's a good sign, and a good sign of things to come. And one other inflation related thing I wanted to mention. I'm sure if you're on Social Security, you know about the big increase coming for next year. That's an 8.7 increase, which is higher.
Whoa! Ding, 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 ding.
That's a lot of money. That's a lot of money. And there are some other things that inflation has affected. And another one that you may have heard about and you may not is the effect it has on the income tax brackets. And that's a little confusing, but I'm gonna take a couple of minutes and just try to make some sense out of it. And this will affect your 2023 taxes. But there's a lot of news out about it now because the information just came out. But to sum it up pretty quickly, our tax system has basically 7 tax brackets. And the top rate is 37%. You might be at 22%. That 22% doesn't mean that's what you pay because it's a graduated system, which means the more you make, the more you pay. So for example, for the taxes you'll do for this year, 2022, the initial rate is 10%. So you pay 10% on the first $9,950 you make. And all over that, up to $40,000, you pay 12%. Once you get past $40,000, you pay 22% up to $86,000, and it goes on and on and on. But for 2023, because of inflation, they broadened those brackets to try to account for the fact that your money's worth less, and so they aren't charging you more for making money that's really just inflationary money. So for 2023, as I said, the first bracket up to 22, up to that 10% tax rate, it's kind of just spread out a little bit more. Or a better example is let's just say the 12% bracket, which this year is from let's say 10,000 to 40,000. Next year it's from 22,000 to 40 to a little over 40,000. 22.
Wow.
Yeah, so it's a broader base, so you get to make more money in the lower tax bracket before you move into the higher tax bracket. So when you hear about that, don't get too excited because it's not for this year's taxes. It won't go into effect until next year, and you really won't deal with it until you do your taxes in 2024.
Hey, Doe, right quick. I just want to slow you down for one quick minute, and because a lot of people don't realize when they hear progressive, we have a progressive tax system. They think it's a flat tax rate at 24% or 22 or 37. But I hope they heard you clearly. It's a graduated tax system. But a lot of people don't know that, Dope. But I just want to reiterate on that point. A lot of people think it's just a flat tax rate, and it's not.
Yeah, well, what makes it confusing, people talk about your marginal tax rate.
Right, that's the other word.
That's the rate you pay on the last dollar you make. For example, in 2022, if you make $40,600, you'll pay 22% on the last dollar you make. But that's not, you don't pay 22% in taxes because the first 10,000, well, let's talk for married couples. For married couples, for the first 10,000, you pay about $20,000. From 20 to 80, you pay 12%. Okay. So if you looked at what you pay in general, it's going to be a blend of that 10 and 12. And as you make more money and you get into the other tax brackets, it's at 22, 24, 32, 35, 37. So your actual tax rate, your actual tax percentage, you have to take all those brackets, add them up, and then see what percentage you're paying. But a lot of times you hear that term marginal tax rate.
Right.
That only relates to the taxes on the last dollar you make. So that's the highest tax bracket that you're in. So that's a good point, Bob. But it is confusing.
Thanks for clarifying that because it could be confusing, but that's it. Thank you. You explained it very clearly.
Yeah, but and the thing is, and what that says is you need to be prepared for that when you talk about your 2023 taxes because the brackets are spread out a little bit. And we're going to do our update show in the next couple of weeks, and we'll talk about that a little more. But it's not too early to start thinking about, one, we'll talk about where you should be this year, but two, what you should be doing next year tax-wise.
Great. That's thanks though. That's some good information, man. Because so many people get confused on those taxes. But
It is confusing. It's
know,
very confusing.
yeah, very, very. So I just want to talk about oh, hold on for a minute here. I just want to talk about the cryptocurrency though. And oh boy, crypto market is taking a beating. It's approximately 70% down though. The
From its
total,
high?
say it again.
70% down from its high?
Yes, from its high.
Wow.
Correct. From its high. And which we always look at the market cap, which is an indicator. The total cryptocurrency of over 18,000 cryptocurrencies, the market cap is down to 947 billion. Just remember over a year ago, it was at 2.7 trillion. The Bitcoin last week was at $19,390. Today, the Bitcoin ended at 7 p.m. at $19,024. It's definitely down, but it's still the number one cryptocurrency. And its market cap has been decreasing too, because this market cap has dropped by, like, since last week, it dropped by $6 billion. Now it's at 365 billion. Bitcoin's market cap, which over a year ago, it was half of the cryptocurrency market of $1 trillion. So that's a lot of sell-off, though. A lot of people sold off and took a lot of profits. Shiba Inu, oh my God, Shiba Inu was the popular meme cryptocurrency. It had 0.0001 is now 5 zeros, 0.00009. It is really, it was at number 12. It dropped down to the 13th cryptocurrency. And last week, the market cap for that was 6.2 billion. It has dropped down to 5.8 billion. So it's taken a real beating. And the Dogecoin, Elon Musk, who's behind that, it's down to 5 cents, and it's down today. And this market cap has dropped. No, actually, the market cap stayed the same at $8.1 billion. So that's the update on the cryptocurrency.
Hey, Bob, before we get rolling, I just wanted to mention one more thing, kind of in the current event situation. I got an email from Norton LifeLock, which I have, but it's given to me free through my brokerage account, and I got an invoice for like $199 or something. I'm thinking, wait a minute, this should be free. So I called the number on the email, and the guy says, "Oh, we can correct that, but we'll have to do it through your computer." And I'm like, "Yeah, okay, hold on." And of course, I hung up. But I just want to remind everybody to continue to be diligent, because they are getting smarter and smarter. And I don't know how they got my email, or if they even knew that I had Norton LifeLock. But that was a pretty slick move, because and they're out there working. So just keep your antenna up and be careful. I just want to remind everybody about that.
Don't give nobody no personal access to your computer. If anybody calling you, asking you for information, by the way, the IRS does not call you. The IRS mails you. Okay, you will not get a call from IRS, and you will not get a call from Social Security. You will not get a call from Medicare, because those are all the scams, and there's so many more out there. And just remember, on the emails, you all watch those extensions. When you see these emails saying it's from Verizon, click on the From button and even though the logo may look like it, normally it's not the logo, but it may look like the logo. But when you click on the to button in the email, it'll give you the where it's coming from and the extension. And normally you'll see it's a private person's name. And Verizon does not send you no private person's name from their email. So
Yeah.
make sure that's another way. Just click on it, you all. You can see it.
Hey,
And
Bob, and
yes,
this thing looks so legit from Norton.
right.
I mean, they had copied everything down. It was very well done. And even more importantly, if you know an older person that we're old, but older than us, who might not be financially savvy, make sure if there's somebody that you're close with or a relative, make sure you set up safeguards with them to make sure that somebody doesn't take advantage of them, because these people are getting better and better and smarter, and take that extra step. If they have a bank that they use, make sure the bank person know who they are, and they come in there with somebody, or they come in there trying to do a big transaction, they should be made aware of it. But it's getting crazy out here with these scamsters. So make sure you are careful yourself, and make sure you protect the elderly or people who aren't financially savvy, because these people are getting better and better at it.
So now, just another tip for the online accounts. A lot of them are using second, what they call two authentications, and a lot of people, sometimes think it's what's the word, inconveniencing to have to put that extra minute. No, if they ask for two authentications, you should use it, you all, because one thing you, for the most part, you all, I don't want to scare everybody. You can't stop this, but you can prevent it. You know what I mean? It's that's the environment we're in. And they say you really can't stop some of this, but you can prevent it. And that's all we want to talk about. Just want to take a sidebar and have that discussion. So Doe, let's talk about our topic today, the stock market after downturns, which is a lot of people. And let me preface this, Doe, before you start. Some people were asking me, like, said, "Oh man, y'all are really on the stock thing," and let me display disclaimer why me and Dodie are on the stock thing, because so many people now, like we talked about this before, we first generations that are in the stock market, whether it's your 401k plan, your IRA, your Roth IRA, these are or your brokerage accounts. Everybody, a lot of people are in the market, and we just trying to give more information. Yes, we pro market, but we pro other investments too. Don't get me wrong. But the majority of people is outside of their home. The next asset is their 401k, 403b plan, IRAs. People, like I said, I know a lot of people that have individual brokers accounts. 529, people investing in their kids 529. So I just want to give that preference why we sometimes hark a lot about the stock market. But
Well, and Bob, we both built pretty significant wealth through the stock market. I mean, that's the main reason we're having these talks. And it's not like we were lucky or inherited, or it's because we, at some point in our lives, when we were younger, we made the commitment to invest in the stock market, and it's done well for both of us. And I think that's the main reason we are pro stock market.
another thing, though, it's not like there's a whole bunch of alternatives either to build wealth. I mean, there's a bunch of things, but as far as being, I want to use the word stable. I don't know if that's the right word, though.
What word?
Stable, like I'm talking about and things that are you're able to invest, because there's so many highfalutin, highly speculative investments out there, but it's not like we have too many alternatives at our hand, because most 40% or more, though, of Black Americans, their biggest asset is their home, and that's it.
Yeah, and Bob, we always preface it with understanding your risk tolerance. And we always look at history and see how the market is done over the long haul. That's kind of a good segue into what we're going to talk about today, I think.
Yeah, I think
Yes,
you're right.
let's get going. It's been a tough year. Bob mentioned this a little bit ago about how much the stock market's fallen. It's probably down 25% in 2022, and bonds have also been down. Usually they work in opposite directions, but this has just been a crazy year. But now interest rates are starting to go up, and that means, if you're in the stocks, that you probably lost somewhere 20%. And if you were like me and in some of the riskier stocks, I mean, the Nasdaq is down more than 30% from its highs, and small companies, smaller stock companies are down more than 30% from their highs too. Cryptocurrencies have taken, as Bob mentioned, they're down 70%. So it's been rough out there. It truly has.
So the thing is now, I mean, so far in 2022, both the stocks and the bond markets have been really taking a hit, really decreasing. And to find another market that even looked like this one, you had to go back to 1969. And nobody likes losing money, but it never feels good to be investing in markets that are falling. There's no doubt about it. But in every bear market, there's a silver lining. There's it's a buying opportunity that can benefit you, and usually it's hindsight. So risk means so many different things to so many different people, so many different investors, and it's dependent on your circumstances and where you are in life. We know that, but today we want to discuss how the stock market has performed after major downturns, because it's been downturn after downturn after downturn over periods of time. But we want to talk about how it pertains and how it affects the different age groups.
Okay, and let's start with baby boomers, which I'm included in that bunch. It's so funny. So much of my life, I was considered baby boomers, and I almost felt young. But now, when you hear baby boomers and you get Medicare, it don't have the same ring to it. You need to come up with a new word.
No, that's actually if you're born between 1946 and 1964.
Yeah, that's I don't like baby boomer and how I feel, but anyway. So, and that's the older generation, and you should have a stockpile of financial assets, but I mean, future savings is not as important as it used to be, and this has kind of caused a problem because in recent years, with bonds and savings yields being so low, a lot of the boomers looking to make some money, jumped into stock market, and instead of being a 60-40 mix of stocks and bonds as kind of traditional, a lot of people jumped more riskier and went 70-30 or 80-20 in favor of stocks. And this can help long term, but it also adds some volatility as we see now with this big downturn. And so for the first time since the 2008 financial crisis, you can finally get some decent yields other than the stock market. So you can look at government bonds, you can look at other bonds that are starting to inch up, and they have been dreadful. And for the last almost 10, 12 years, it's been really crazy. So it's kind of been bad for the older folks. And I say bad in the sense of if you went to look for yields, you probably had to get in something risky, and it's probably caught up with you now. So right now, interest yields are starting to get better, so you do have other alternatives than the stock market.
Yeah, that's well, but now the yields are so much higher, the margin for safety should, is starting to, the margin for, investors have a much bigger margin of safety should rates continue to rise. Because, like you said, the short-term bond prices are really going down. And like you said, what did you say? Was it the 10-year Treasury?
Yeah.
that it's I mean, like, shoot, man, over a year ago, it was or a year and a half ago, it was less than 1%, somewhere
Right.
around like 2%.
It's almost zero.
Right, it was almost zero. So, but there, but for retirees now, you can lock in like to bond yields that's giving 4%, and they have very little interest rate sensitivity. Because remember, the shorter the term for a bond, the less volatility when it has to do with interest rate movement. But now, the longer term bond you have, the more interest rates are affected. And in the past, like those say, it was like an inverted curve. Like if interest rates went up, people went towards the high interest rates, but bonds were lower. But then when interest rates go down, people go to safety because bonds are given a little bit higher interest rate, and they backed by the full, at least treasury bonds are backed by the full faith and credit United States government. So you got a lot more safety there. So us baby boomers who are who need to be in a safe place, and looking at a defensive part of your portfolio, you now have some options because now look at some of the daggone CDs, dope. Some of the CDs are paying like 3-4%.
Yeah,
Which
you just gotta be careful though, because we're talking 4% yields, and we're also
yes,
talking 8-9% inflation. So you still are going in a negative overall position, and that's why you have to have. You don't have to, but that's why you should have some money in equities to try to make up for that shortfall.
correct, correct.
Okay, now let's talk about the Gen Z and millennials. What age group is that, Bob?
Okay, Gen Z is 1997 to 2012.
Okay, and that's the younger investors. Now they're on the opposite end of the stick from the retirees. They also need a safe place to park their safe assets, their emergency money, their down payments, money for weddings or any short-term goals. But they got time on their side. Okay, and that's the best thing you can have as an investor. And so you got time to allow compounding. We've always talked about how compounding works and the tremendous effect it can have on your earnings. You can wait out bear markets without, you should wait out bear markets without losing much sleep, because you're going to make it up because you have so much time for it to grow. And so for young people doing a bear market, keep saving, keep investing, don't get scared, and don't run from the markets, don't panic, just be patient, have a long-term view, keep saving. It's going to work out. This is probably your first downturn. Just bear with it. It happens. It happened before. It's going to happen again. You should come out of this on the good side down the road. Now, bad news if you're fully invested or put money into a savings account right now. Of course, the S&P being down 25% from its all-time high, that's kind of a shock for you. But again, it should come back. And the numbers go back to 1950, show what happens after a downturn. If you would have bought after the stock market has fallen 25% or more. Bob, you want to show that chart? Okay, here we go. And these are some of the downturns that have happened in the past. And you can see what the returns look like 1, 3, 5, and 10 years after that big drop. And all the periods saw positive returns but one, and that was after the great financial crisis. Of course, there's no guarantee that what's happened in the past is going to happen in the future, but young people should be happy to know that there's some pain now, but over a long term, you're probably going to do okay. And if you let's look at a couple of these specifically. Let's go back to the peak in 11/29/68, and the trough was in 5/26/70. 36% decline. 1 year later, market is up 32%. 3 years from there, the market's up 44%. 5 years from there, 27.9%, and 10 years later, 97.5. So again, if you're young, if you look at all of those instances where the market took a big drop, it always came out on the other end doing okay. And you look at the averages, you can see history has said after a very bad or after a bear market, doesn't stay down. The market does get better. Doesn't do any good if it doesn't help you much if you put all your retirement money in the market and it's down 25% now. You don't have that luxury of youth on your side to get all those years of compounding. But again, after 1 year, 3 years, the market should be back up.
I look at the second column, which says the trough for 2002. I remember that was that I guess that's George Bush, and I think that's 9/11, right? Somewhere in there.
I think so.
It dropped 9. I remember, man, my portfolio dropped, and it was 40%. This is 49%. But in 3 years, it went up to 1. It took 3 years for it to get to 1.9%. But then the 5-year, it ended up being 21%. And then the 10-year, 38%. And that was one of the lowest years that it took for it to recover. Because I look at all the other ones, man, like from 2009, the economic downturn of 56%, almost 57. In 10 years, that one grew to over 209%.
You look at 07. Look at the one that we did, the last one we went through.
Yes.
That's the crazy one.
That's crazy, man. And you look at that 1 year after it was like about 7%. Then if you look at 3 years, that's why it's all about the long play and patience, man. Because and once again, past performance is no indicator of future returns, but it does give you an indicator of how things have worked. So it's worth looking at, that's for sure. But that chart is so dope. Whenever I see that chart, man, it is so telling to me, man.
Well, it's encouraging to me. It knows
yes.
there's something on the other side.
Yes.
Just got to be patient.
Because so many people, man, fear the stock market, man, and a lot of people, but all the boats are down. You know what I'm saying? That's why I was trying to tell the one guy. I said, man, I don't know your personal situation, but I know I can tell you this: everybody's stuff is down.
Yeah, and this is when you get the people who say, see, this is why I don't invest in the stock market, because they don't look at all the years that it goes up. It goes up way more than it goes down. And overall, if you've been invested in the stock market, you have way more value than had you not been invested in the stock market.
Yeah. So let's talk about the Generation X, which is like the middle age, though. That's like 1965 to 1980. That's like 41 to 56 years old, right?
Yeah.
Now a lot of these retirees generally have lots of financial assets, but little in the way of human capital, which we mean by human capital is the potential for future earning power, meaning your age. Now, young people typically have little in way of financial assets, but plenty in human capital to save in the future. That's because of compound interest. The younger you are, the more time you got for compound interest to work for you. But if you're in that Generation X level, and you heading you in that area, where you're middle aged, and a lot of times Generation X is often forgotten generation because the baby boomers and the millennials get much of the attention. But the generations that were born between 65 and 1980, in that range, they really, really need to look at, they sometimes they say that they look at the glass as half empty and half full. They're caught right in the middle of that. But it stings to see the value of their portfolio go down. Nobody likes seeing their portfolio decreasing. but it's also nice to know that, when the stocks are down, there you get the advantage of getting a discount, sell, and you can actually have some money to do so. So this age bracket should be approaching their peak earning years. And when they are able to put even more money to work in the markets than before. So don't be scared, don't be scared. And like the older generation X's, they also probably be thinking about slowly but surely getting into more defensive stocks, like we talk about, like the bonds. And the good news, like we said, the defensive assets such as bonds are now much higher, and the stock prices are lower. But now you can get the best of both worlds. You can buy into the stock market at a discount and get a better benefit, and then you can also put some money into some of those defensive bonds, and they've got ETFs, electronic traded fund bond funds that people can invest in. So risk is often in the eyes of the beholder, especially when it comes to investing. But it never completely goes away. It just changes its shape, and it depends on where you are in your life cycle as an investor, whether you're baby boomer, millennial, Gen X, Y, Z. It just depends, and it's so important that you understand where you are and then understand your risk tolerance based on your generation. And it all balances out in the long run if you have a plan based on just a steady, solid, firm planning.
Yeah, let me try to put a bow on it, Bob. Downturns happen all the time in the stock market. And if history repeats itself, the stock holdings are going to be worth way more than they are now in the future. They're going to go up. They've always bounced back in the past, and they probably will bounce back this time. In the meantime, there's nothing more important than sticking with your long-term strategy. Keep investing, consistent clip, ensures you'll be buying at lower prices now. We always talked about averaging, investing averaging. You're buying more shares at lower prices, but you're consistently investing. If you have a very well laid out plan, probably shouldn't make any big changes at this point. And one thing you should avoid is looking at your situation and saying, okay, what's doing good now? And jumping out of your diversified portfolio and trying to jump into something that's rolling right now, like energies or commodities or anything that's rolling right now and say, oh, this is where I should be. No, if you've taken the time and laid out a good plan, stick with it. Just buying the recent thing that's going good, that's pure disaster. It's recipe for disaster. So make sure you don't do that.
And then the other thing is, like we said last week, you need to learn and understand, your own investment. Don't stop learning. And then once you learn, like the information we give you, share it with other people so that it can help them. So let's take it to the summary and takeaways and wrap it up for this evening. Downturns happen, you all. As you saw from that chart we showed from, all the way back into the 60s, all the way up to now, downturns happen. But you can take advantage of those downturns if you just plan, be patient, be consistent, and they happen. They happen. Just do not let it make you jump out of your plan.
And don't panic. Whenever we talk about investing, we talk about understanding your risk tolerance. And we've talked about possibilities of the market going down. It's happened in the past, as Bobby just said. So don't panic. Stick to your plan. Keep investing. You'll be okay.
Look for opportunities in bad times. Okay. After every downturn, there's a silver lining, but you just gotta, while you're in it, you gotta be able to sort through all the misinformation, the crazy noise out there, the scams. You gotta filter through all of that. But there are opportunities, and this is the time to take advantage of them. Just know your risks and take your time. Don't be trying to get rich quick overnight. That's the key. Slow and steady. Take advantage of the opportunities.
And finally, what goes down will come up. We've shown you in history of every downturn, the market has ended up better after a few years. So realize we're in a down market now, but it's probably going to be up in a few years. And if you stick to your plan, stay invested, you'll reap the benefits when the market does turn around.
So, with that, you all, that's our show for this evening. We're always looking to know, we want to know what's on your mind. So, please feel free to put comments out there, and please share this information with other people, because one of the things that we lack is just information. And Kitty said, trying to hit the Powerball, right? Thank you, kid. Stop trying. I mean, I don't have no problem with you putting $2 in there. But don't. I hope that's all you put in there. Those not bad. Cause a big economist actually did a test, right? How they do, economists do these forecasting, right? And he said your chances of hitting the lottery you have a better chance, excuse me, of standing on the Empire State Building with your back turned to the street and throwing a quarter over your shoulder and it landing in a cup. Though you have greater odds than hitting the lottery. That's your odds.
Wow.
So I have no problem with playing the lottery, you all, but don't let's have a better plan. And so with that, thank you, everybody. Thank you, Garnett, as always. She says slow and steady.
That's for sure.
What's up, Carl? My sister Nolia, Kitty, thank you for checking out. Hey, now, what's up now? Glad to see you out there, girl. Thank everybody. Joanne, as always, Skinner, she stays on too. Look forward. Thank you. But look, you all, have a wonderful week. And remember, slow and steady. Keep investing. Have a good evening.